Excuse the dog snoring and the kid playing in the background, but let me read to you from an article from Kiplingers, which is an investment magazine. With oil demand so weak due to COVID-19 restrictions, places to store unwanted crude filled up, and traders in oil futures scrambled to unload their positions in crude. Eventually, some had to pay buyers to take future deliveries off their hands. That means that oil was actually below $0 a barrel. That's my commentary. Negative price didn't last long, but oil stayed very cheap for much of 2020. That led energy companies in major oil exporting countries and OPEC to slash their production because no one wanted to give away barrels of oil at such rock bottom prices. Since then, the world has slowly gotten through the pandemic, and oil demand has come roaring back, especially in the U.S. Unsurprisingly, consumers who missed out on travel and other normal activities in 2020 and 2021 are making up for lost time now. U.S. oil demand is about back to where it was pre-COVID, but oil production, italics is theirs, takes a lot longer to restart than oil consumption. Italics is theirs, not mine. Idled wells can't be easily restarted. Drilling new wells takes time, and oil producers have been cautious about opening the taps quickly, lest a new price drop burn them again. Here in the U.S., oil output has only partially recovered from its 2020 drop. OPEC and its partner nations are only gradually restoring the exports they took off the market during the worst of the pandemic. That mismatch between supply and demand helped push oil higher throughout 2021. They got another major boost in early 22 when Russia invaded Ukraine. All this has set crude prices above $100 a barrel, which in turn pushed the average price of regular gas well above $4 a gallon this spring. Energy companies are not rushing to drill oil. I skipped a section about moving away from oil, and I'll jump to this section. Even now, with prices soaring, energy companies are being cautious about ramping up their oil output. They're slowly putting new rigs to work drilling more wells, which helps, but they're also limiting how much they invest in new production so that they can reward their investors with bigger dividends and stock repurchases. That's good for stockholders, but it means less money going towards pumping oil, which isn't great for consumers. They talk about investments here because Kiplingers is an investment magazine. And they recognize that some of the people that read their magazine are invested in oil companies. So they're reporting on this both from the pro and con side of things. Will gas prices go down soon? They ask. Unfortunately, it doesn't look like gas prices are going to head much lower anytime soon. The war in Ukraine shows no sign of ending. Global oil demand is straining available supply, and Wall Street wants publicly traded energy companies to grow their production slowly so that they can keep returning cash to shareholders. From the people that invest in oil, oil and gas prices are going to stay high because they can take money from your pocket and they can put it into the pocket of investors like me.